This is Nightly Business Report with Bill Griffith and Sue Herrera.
Record revenue. Microsoft's cloud computing business keeps growing, adding to the value of the trillion-dollar company. Big hit. Boeing is going to take a nearly $5 billion charge related to its 737 MAX, putting a dollar figure now on the cost of the grounding. And the final frontier. The nation enters a new era of space exploration 50 years after mankind first set foot on the moon. Those stories and much more tonight on Nightly Business Report for Thursday, July 18th. And we do bid you a good evening, everybody, and welcome. Sue is off tonight. Microsoft is on cloud nine. The largest publicly traded company today topped earnings estimates and reported record revenue thanks to growth in its cloud computing unit called Azure. It is clear that Microsoft's big investment in the cloud appears to be paying off. In fact, at least one analyst said that the pace of growth at this scale is unprecedented, and that helped lift the stock in initial after-hours trading tonight. John Ford has more on Microsoft's quarter.
Well, the one takeaway from Microsoft earnings today is cloud momentum continues. The company's beat was really grounded in Azure's strength, but not just that. Office and LinkedIn also continue to be strong, and particularly that unit, including Office and LinkedIn, helped the profitability of Microsoft just get even stronger than it had been in the past. And that's why this is a trillion-dollar company and still going on at the end of this fiscal year. For Nightly Business Report, I'm John Ford.
Now to Microsoft's fellow Dow component, Boeing. Late today, the aerospace company said it's going to take a nearly $5 billion charge for problems associated with the grounded 737 MAX airplane. It also said the cost to produce the 737 MAX is increasing. That sent the stock higher in initial after-hours trading tonight. Phil LeBeau is on that story for us right now. Phil, what does this charge cover? What's it for?
Well, they're saying it's for considerations and concessions that they're going to have to make to their customers, not just those that they've made in the second quarter, Bill, but those they're going to have to make over the next couple of years. Remember, they have a number of airlines and aircraft leasing companies that were expecting to be flying the MAX. They are not flying it, so they have a reduced schedule. Their revenue has taken a hit, and they just don't have the full complement of the fleet that they expected to fly. That's part of this charge. And the most important thing that came out of this announcement, Bill, is the fact that Boeing is sticking with its plan, or its assumption, I should say, to see the 737 MAX back in service in the fourth quarter. There have been a number of people who have said, you know what, I'm not really sure this is going to fly in the fourth quarter. Let's push it out to 2020. But Boeing is saying it is making the assumption, based on its discussions with regulators, that it will return to service in the fourth quarter. And
all U.S. airlines to this point have canceled their flights until November 2nd, which is smack in the middle of that fourth quarter. What happens if it goes beyond that?
They have to push it out even further. The one part of this that is a particular pain spot for the airlines is that they were not only, look, they've already lost those planes they have delivery of, and they're parked, they can't be flown, but they were supposed to take delivery of more MAXs throughout 2019, Bill. Those are likely not to be delivered until well into 2020, if not late 2020, so they're not going to have the full complement for some time.
Phil LeBeau on the Boeing beat for us tonight. Thanks, Phil. Certainly, you well know that one of the biggest risks to the market right now comes from Washington. Lawmakers must act to lift the federal debt ceiling. Otherwise, the U.S. defaults on its obligations, jeopardizing the full faith and credit of the U.S. government. And today, there were some new developments on that story. Ilan Mui reports for us tonight from our nation's capital.
Treasury Secretary Steven Mnuchin signaling today that the White House and Congress are moving closer to a deal to lift the debt ceiling. The outline of their agreement would raise the nation's borrowing limit for 2 years. It would also set 2 years of top-line federal spending numbers and include offsets for spending increases.
I don't think the market should be concerned. I think that everybody is in agreement that we won't do anything that puts the U.S. government at risk in terms of our issue of defaulting. And I think that nobody wants a shutdown in any scenario. So I don't think the market should be concerned, and we're working hard. We'll get there one way or another.
But a source inside the White House tells me there are still several issues that need to be resolved. where to find roughly $150 billion in offsets or even more, how to constrain future spending after this deal expires, and poison pills in the appropriations bills that have already passed the House. The Treasury Department could run out of cash in early September, while Congress is still on recess. So lawmakers are scrambling to pull together a deal before they leave over the next 2 weeks. Mnuchin has been in regular contact with Capitol Hill, speaking with both Democratic and Republican leadership over the phone today.
We should not leave here without doing something on the debt ceiling. If that even means 30 days, should not come in doubt about the debt ceiling in any shape or form.
Both parties caution that nothing is final until everything is final. For Nightly Business Report, I'm Ilan Mui in Washington.
And as Ilan just reported, the Treasury Secretary did say that investors should not be concerned about this. But how have the markets performed in the past during similar times of stress in D.C.? We asked Dominic to take a look.
Wall Street has not generally reacted well to fiscal uncertainty. In the last decade, there have been numerous cases where market volatility was the result of budget and debt ceiling impasses. One happened in the summer of 2011 when lawmakers were stuck in negotiations that could have led to a government shutdown. Ultimately, the worst was avoided, but concerns over America's future fiscal path led credit ratings agency Standard & Poor's to cut its rating on the U.S. for the first time in history. And let's not forget the European debt crisis was raging at the time market volatility surged. In the fall of 2013, the government shut down. The week before, markets were weaker. During that same time period, lawmakers were also grappling with the validity of the Affordable Care Act. And at the end of last year, a budget impasse led to the longest partial government shutdown in U.S. history. At the same time, investors were concerned about interest rate policy from a Federal Reserve that looked to tighten financial conditions. In each of those scenarios, there were two common threads. One, that fiscal policy was surrounded by other negative market catalysts in play at the time. And two, when a resolution was reached eventually, the initial volatility smoothed out and the markets ended up higher. For Nightly Business Report, I'm Dominic Chu.
On Wall Street, stocks made only modest moves today despite a focus on three things: earnings, which so far have been mixed; Iran, after President Trump said that the U.S. destroyed an Iranian drone over the Strait of Hormuz; and the Fed, following comments today from a senior Fed official who said the central bank will take a more aggressive stance to ease monetary policy. But all of that was not enough to move the needle. The Dow Industrial Average was up just 3 points today to 27,222. NASDAQ added 22 points and the S&P rose by 10. Clearly, Wall Street has a huge wall of worry to deal with right now, economic and political issues both domestically and abroad. But lately, the market has not been reacting to a whole lot of that. So what exactly is it waiting for? We're joined tonight by Chris Zaccarelli. He's Chief Investment Officer at Independent Advisor Alliance. Chris, thanks for joining us tonight.
Thanks for having me.
We've had years ago, I would have attributed this to the summer doldrums, but anymore we don't have summer doldrums on Wall Street. But it's certainly acting that way right now. Why do you think that is?
Well, you see the markets going sideways. They're waiting to see what's going to happen with corporate earnings, where corporate earnings have really just kicked off in the last couple of weeks. We're about 10% of the way through the S&P 500 reporting season, and about 3/4 of the companies are beating expectations. But those expectations have been lowered, and in fact, earnings are expected to be flat to even slightly down for the first half of this year. So the market's really not reacting positively or negatively off of that news. It's going to take some type of surprise, whether a positive surprise in earnings or a negative surprise in earnings, in order to move this market, now that the Federal Reserve and China seem to be on the back burner for the time being. Yeah,
I mean, today we should point out, after Fed President Williams said that he feels the Fed should be more aggressive with monetary policy, that Fed funds futures are anticipating a 50 basis point cut by the Fed later this month. Is the market setting itself up with expectations that are a bit too high, do you think?
It's possible. I think most of the market has priced in a 25 basis point cut. And to your point, just recently, it's now starting to price in 50 basis points. It's possible that's a little bit too much for what the Fed will do. But if you listen to what the Fed president said today, he was talking about making a drastic cut and making one in advance of it being necessary. So really they're talking about an insurance rate cut and potentially doing more in a shorter period of time. So he may have been hinting that actually the market was right that they were going to cut, but actually they were going to cut twice as much as expected. So it's possible the Fed in this case is leading the market, and that's why I think you're seeing a repricing in the Fed funds futures.
And quickly, of course, as far as trade goes, expectations are about as low as they can possibly get. The administration has been guiding lower, it seems, every day. So I guess, if anything, the next move there would be higher if we get some developments on it, right?
I think that's exactly right. I mean, the most likely scenario is that they kick the can down the road, continue to negotiate, and neither talks completely fall apart nor an agreement is reached in the near term. And in that case, I would expect us to go sideways. But you're absolutely right. If there's any type of positive developments in trade negotiations, a sign that we're getting closer to the end and then an agreement will eventually be reached, I think that would be very good for the stock market.
Chris Zaccarelli with Independent Advisor Alliance. Again, thanks for joining us tonight.
Thank you.
The mantra in the media world for years, of course, has been that content is king, and Netflix may be learning that the hard way. As we told you last night, the streaming service added fewer subscribers than expected in the past 3 months, and that sent the stock down 10% today, in part, the company said, because of its lineup of shows. Julia Borston has our details.
Netflix has seemingly endless content, but it turns out it's a hit-driven business. And in the second quarter, the company added 2 million fewer subscribers than expected. And in the U.S., it actually lost subscribers for the first time in 8 years, which Netflix says was in part due to the fact that it didn't have enough big new shows.
What we just learned is that original content, big hits, drive subs.
At least someone's happy I'm home.
Hit show Stranger Things, returning at the beginning of the third quarter, kicks off a strong second half of the year, according to CEO Reed Hastings. A number of popular shows are returning with new seasons, such as The Crown and 13 Reasons Why. There's also a Martin Scorsese movie, The Irishman, debuting in December.
If content is what drives subs, content's coming in the second half of the year. This is going to be the strongest content slate they've had in a long time. That should lead to really good sub numbers.
One thing that could give Netflix's content slate an advantage: shows from the big TV producers such as Ryan Murphy and Shonda Rhimes. It's lured over from the networks with pricey exclusive deals. Ryan Murphy's first show, The Politician, hits Netflix in September. Netflix content chief Ted Sarandos says continuing to innovate to create shows and movies that drive water cooler conversation will be the company's priority, especially as it loses some of its most popular licensed shows, such as The Office and Friends, to coming rival services.
We grow through that by, we believe, by making these early investments in original programming and getting our consumer and our members much more attuned to the expectation that we're going to create their next favorite show, not that we're going to be the place where you can get anything every time.
And with Disney and Apple launching competitors in the fall, and then HBO Max and NBC Universal streaming services coming out next year, the competition to find the next favorite show is going to be more fierce than ever. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Time to take a look now at some of today's upgrades and downgrades. We begin with shares of Apple. They were upgraded to outperform from market perform at Raymond James, with the analyst citing confidence in next year's 5G iPhone cycle. Price target $250. The stock rose 1% to $205.66 today. Advanced Micro Devices was downgraded to neutral from buy at Mizuho. The analyst cited the stock's valuation after a nearly 80% gain so far this year. Price target $37. Shares fell more than 1.5% to 33 even. And Qualcomm was downgraded to equal weight from overweight at Barclays. The analyst says the stock will be range bound going into next year. Price target $75. That stock fell nearly 2% to $74.37. Still ahead, the price of privacy. An app goes viral and Washington calls for an investigation. The House today voted to raise the federal minimum wage for the first time in a decade. The legislation moves it to $15 an hour by the year 2025. Now, some cities and states have already made that move, including Seattle, San Francisco, New York, and all of California. Amazon adopted the $15 minimum last year. Other companies have done the same, but experts say there's little chance that this House measure will be taken up by the Senate. President Trump said today that his administration is looking closely at a cloud computing contract the Pentagon is going to award soon. Amazon and Microsoft are the two finalists for that contract that could be worth $10 billion. Mr. Trump said he has received complaints from other tech companies, some of whom said that such a large and important contract should be awarded to more than one company. Also in Washington, a wildly popular app is coming under scrutiny. A leading senator is calling for the FBI to investigate it, and the Democratic National Committee is warning against using it altogether. Andrea Day explains why.
It's the app that can make you look decades older or younger in just seconds, with millions tapping into the technology, posting shots all over social media. But the viral hit Face app is now under fire, with fears that personal data could be shared with the Russian government. The company behind it is located in St. Petersburg. Brian Vecchi is the field CTO at data security company Varonis.
This particular app is under fire because suddenly people are realizing I'm uploading potentially very personal information to a company in Russia.
Senate Minority Leader Chuck Schumer already calling on the FBI and FTC to investigate, and the DNC urging presidential campaigns to delete the app immediately. Late today, the app maker adding a warning that pops up when you take a photo, leaving users to decide if they still want to go ahead. According to FaceApp, we only upload a photo selected by a user for editing. We never transfer any other images from the phone to the cloud. And most images are deleted from our servers within 48 hours. We don't sell or share any user data with any third parties. And even though the core R&D team is located in Russia, the user data is not transferred to Russia. But Vecchi still has concerns.
We just kind of have to assume that once we give somebody our data, they're going to do whatever they want with it.
And he says even using the app once and deleting it could still be an issue. And getting FaceApp to delete your data also takes some work. You have to click on settings and support and then send an email, and there's still no guarantee. I'm Andrea Day for Nightly Business Report.
Let's turn to Ian Scher to talk more about the growing privacy concerns involving FaceApp. He's, of course, executive editor at CNET. Welcome back. Good to see you again.
Hi, how are you doing?
This has been around for a while, this app. What happened? All of a sudden, it's on everybody's radar screen.
A couple of celebrities started posting online their photos of their aged faces, and it kind of took off. It was really amazing. I saw it just starting to pop up in my Twitter timeline. A couple of my friends did it. The photo actually has the FaceApp logo in the bottom right of the photo, so you automatically know where it came from. You just search the App Store, download it, which is what I did, and then I immediately took a photo, aged myself, and uploaded it. So I was part of that whole thing, but it was really kind of this just thing that took off in the middle of the day.
But you're not as concerned about the security issues that some are. I mean, Chuck Schumer, as we said, is calling for an FBI investigation, I guess mainly because this is developed by a Russian developer, yes?
Yeah, I mean, I haven't seen any hard evidence that shows that this is something to worry about. What I'm glad about, though, and this is something we've talked about on CNET many times, is that it's reminding people to be thoughtful about what permissions they're giving apps when they download them to your phone. You know, when you start up the app for the first time, it'll ask you if you can give it access to your photos. All of your photos. And I said no, of course, but a lot of people just press OK because they're used to that. And that's one of the things is it started this conversation I think is really healthy about where is our data going, who are we trusting it with, and how are we handling it? And that's not something we've all done very often in the past.
We all have the memories of what came out of the 2016 election, the involvement of the Russian government or Russian developers of some kind. I guess maybe we're just learning something. But are we too paranoid about it at this point?
Well, that is that. Look, being too paranoid at this point, I think, is not a bad thing when it comes to the app world. The thing we all have to be reminded of is that there are unscrupulous developers out there. And if you don't know who you're dealing with, you should be very thoughtful about who you're giving your data to. And that is a good lesson to learn. Now, just assuming that this is a bad company and a bad app because it comes from Russia is a little over the line, right? I'd like to see more evidence that it's dangerous first. But I'm very happy to see people thinking about these things now instead of waiting for a big hack or some other horrible thing to happen to say, oh, I should have thought about it before.
Indeed. Ian Scher with CNET again. Thanks for joining us tonight, Ian.
Thanks for having me.
Elsewhere, United Health Group sees a growing growth in its membership, and that's where we begin tonight's market focus with the parent of the nation's largest health insurer beating estimates, helped by an increase in premiums and services. The company also raised its full-year guidance, but shares still fell more than 2% today to 260.60. Morgan Stanley also reported better than expected earnings and revenue, thanks in part to gains in its wealth management and fund divisions. But the company posted a 14% decline in revenue from equities trading. That was the steepest of all the major banks, as a matter of fact. Yet the stock rose 1.5% today to 44.43. Union Pacific topped earnings estimates thanks to cost cuts and price increases to combat Midwest flooding and trade tensions between the U.S. and China. Despite evidence of a slowdown in the transportation sector, Union Pacific CEO said today he is not concerned about a possible freight slump.
We see a little impact from the coal and energy markets, and then we do see a little impact from trade. But I can't say that we see some kind of inflection point occurring right now that would make me think that the third quarter or fourth quarter is getting much worse than what we see right now.
Union Pacific rose nearly 6% today to 174.25. Philip Morris beat expectations as that tobacco company saw growth in a new product that heats tobacco instead of burning it. Company also raised its full-year guidance, and stock rose more than 8% today to 87.71. And then after the bell, online pet product company Chewy reported its first results since going public, and earnings and revenue were in line with estimates. Shares were volatile, though, in the after-hours trading session tonight. They closed the regular session up nearly 4% to 32.85. Coming up, the next lunar step. The space economy is being redefined by a new generation of explorers. Volvo today warned that the U.S.-China trade war could put a dent in its profitability. The automaker plans to cut costs due to the impact of tariffs and pricing pressures. It did say, though, that it expects to see improvement in the second half of this year. Many car makers have been coming under pressure from the trade tensions, as well as from big investments to develop electric and driverless cars. Finally tonight, of course, this weekend marks the 50th anniversary of the Apollo 11 moon landing, when astronaut Neil Armstrong took that one small step for a man and one giant leap for mankind. Well, 5 decades later, a new era of commercial spaceflight is being ushered in, fueled by some very wealthy entrepreneurs. Morgan Brennan takes us into the final frontier.
50 years ago,
the Eagle has landed.
The first humans stepped foot on the moon. The historic Apollo 11 mission cinched America's dominance in space, a lead that continues but waned after the Cold War's close. Now, that's changing.
Liftoff.
Companies like Elon Musk's SpaceX pioneer reusable rockets that cut the price to go to orbit, ushering in a new era of billionaire-backed space exploration that gives the U.S. more options as it rethinks its strategy for the final frontier.
Now's come the time for us to make the next giant leap and return American astronauts to the moon.
NASA's new lunar program is Artemis, named after Apollo's twin sister, the Greek goddess of the moon. It would send Americans back in 5 years, a feat that can only be achieved with the help of the private sector. Chad Anderson, the CEO of early-stage investment firm Space Angels, says we're in an entrepreneurial space race.
We've gone from a dozen privately funded companies in the world to now 476 companies today. They've raised $22 billion of equity capital.
One startup Space Angels has invested in, Astrobotic.
It's kind of like a railroad to the moon.
Astrobotic, which builds robotic landers, has almost $100 million in contracts, including recent awards from NASA.
We offer NASA a much more affordable opportunity to regularly fly payloads to the surface of the moon. And that's going to open the doors wide open to scientists and explorers and technology developers all over our country and all over the world to begin to understand the moon in much better ways.
It's just one example. Companies are focusing on everything from rockets to moon mining to habitats. Jeff Bezos' Blue Origin has spent the last 3 years designing its own lunar lander, Blue Moon. Another example, the Lunar Gateway, a space station that would orbit the moon, which several contractors, including privately held Sierra Nevada Corporation, are competing to build.
The purpose of that is for NASA to launch exploration missions from there and support exploration of the moon and then eventually other locations.
But it will all take more money, up to $30 billion over 5 years, according to NASA. For Sierra Nevada's Lindsay, a former space shuttle commander, it isn't a matter of whether space goes mainstream, but a matter of when.
I want to someday walk into a school and say, "Hi, I'm Steve, I'm an astronaut," and all the kids look at me and say, "Big deal, there are a gazillion of those." That's my goal.
For Nightly Business Report, I'm Morgan Brennan.
And that is NBR for tonight. I'm Bill Griffith. Thanks so much for watching. Have a great evening. See you tomorrow.